Hello and welcome to the lecture for Chapter 2. This chapter really gets into the practical details of how we record transactions and then get to the point where we can create a trial balance and produce financial statements. So there's a lot of detail here, so you may need to kind of pay particular attention to this. Make sure you read the chapter in the textbook first, then print out this PowerPoint presentation, and then take notes as you listen to the video. So accounting and double entry accounting and how we follow generally accepted accounting principles in the United States is based on some assumptions and principles. I want to talk about each of those real quickly. So the first one is separate entity assumption. That means that the economic activities of the owner personally are separate from the transactions of the business itself. So we're producing financial statements for the business, so anything that's involved with the personal transactions of the owner are not included. Next, going concern or continuity assumption means that it is assumed that the business is going to continue operating into the foreseeable future. This is primarily important in terms of valuing assets. So you can imagine if a company had a one-of-a-kind machine that is only valuable for making their product, if they're going to go out of business in the next 3 months, well, what's the real value of that machine? It's virtually worthless. So the assumption is that that machine is going to keep making products into the foreseeable future, so we can record the full value of that machine. So that's what going concern is about. Next is monetary unit assumption, which means that everything that we do is going to be displayed in US dollars. We may have transactions in other currencies. We may do transactions in Canadian dollars or Mexican pesos, but we're going to convert all of that into US dollars when we record those transactions. That way we're not kind of mixing apples and oranges. And then last, historical cost means that we're going to record figures on our balance sheet that are at the cost at which the asset was originally acquired, not its current value. That helps financial statements be objective because you can point to third-party produced evidence, an invoice for the machine, that sort of thing, as evidence of what the figures are. So a little bit about balance sheet elements. So you can see here this is a classified balance sheet, and the word classified means that it's broken down and subtotaled, so you get more information than just a straight listing of all the balance sheet accounts. So here we have assets, current assets. The definition of a current asset is an asset that is going to be used up or turned into cash within the upcoming 12-month window. That's a moving 12-month window. So in this case, they have cash, which is money in the bank, short-term investments, so those are maybe stocks or bonds that they own of other companies, could be certificates of deposit at a bank, those sorts of things, but they're investments that they intend to hold for a short period of time and then turn into cash. Accounts receivable is the money that's owed to us from people to whom we've provided products and services. Supplies, of course, you know what supplies are, and then prepaid expenses are expenses that we pay for in advance of actually incurring the expense. Supplies is one form of a prepaid expense. We also might have prepaid insurance or advertising, those kinds of things. This company then has property and equipment, which includes land, buildings, and equipment. Those are long-term assets that are going to benefit more than the current financial period. And then they've got intangible assets at the bottom there. And intangible assets are assets that, as the name implies, are intangible. That we can't see them or touch them, but they still exist and have value. Patents, trademarks, things like that. Then we've got the liability and stockholders' equity section. So we have current liabilities. The definition of a current liability is any liability that needs to be paid within the upcoming 12-month window that's going to be paid with current assets. So the one exception there is if a business has the intent and ability to roll over a debt and replace a debt or pay a debt with a new debt, then that would be considered long-term. So it wouldn't be considered current. So this company has accounts payable, unearned revenue, which is money we've received in advance of earning it by providing a product or service, and then accrued expenses payable, where we record expenses, for example, wages, utilities, and lease liabilities in advance of recording the expense. We have notes payable. In that case, we have a long-term lease liability, and then we've got stockholders' equity, which includes common stock, additional paid-in capital. Those two accounts together are called contributed capital. It's what people have given us in return for shares of ownership. We have treasury stock. Those are shares of stock that we've repurchased. And then we've got retained earnings. And again, we always have to make sure that total assets equal total liabilities and stockholders' equity. This is a sheet that you might want to print out in full size from the PowerPoint. It's a good cheat sheet. A lot of times students have trouble seeing the name of an account or an account description and deciding, well, what category is that really? So this gives you some kind of helpful hints about that sort of thing. Every business is going to use different terms for different things, but there's some things in common. Whenever you see the word receivable, it could be note receivable, interest receivable, accounts receivable, those are always going to be assets. So keep that in mind. If you see the word prepaid, it's also going to be an asset. Generally, anything with the word payable in it is going to be a liability. If you see the word unearned, it's also probably a liability. And then revenues is going to contain the word revenue in most cases, and expenses usually contain the word expense. But again, you might want to print this out and keep it handy just as a way to keep track of that. So I want to look at some transaction analysis and talk about it here. This kind of should be a refresher from Accounting 200, but we're going to go from this kind of way of looking at transactions to a journal entry way of looking at transactions. So you can see here under the title Transaction Analysis, we have the accounting equation, assets equal liabilities plus stockholders' equity. We've broken those categories out into some further subcategories. So within assets, I have a category or an account called cash. I have account receivable and supplies. Hopefully you can understand my abbreviations there. Under liabilities, this company has three types of liabilities. Accounts payable, that's what we owe our suppliers. Salaries payable, what we owe our employees. And notes payable, which is a longer term, more formal kind of debt, usually with a bank. And then under stockholders' equity, we have common stock and we have retained earnings. Retained earnings is all of the past net income of the company that they've retained in the company, meaning they've not paid it out to shareholders. Now, all transactions that impact a business are going to fit in this equation in a way that keeps it balanced. That's how we're going to record transactions. Those transactions are in four types of categories. So we have asset source transactions, that's money or resources coming into the company. We have asset use transactions, that's assets being used up or leaving the company. We have asset exchange transactions, so exchanging one asset for another. And then claim exchange transactions, where we exchange one claim on the company's assets for another. And I'll go into detail on each of those. So asset source transactions, again, when you have this printed out, I'd recommend that you write in there what each of these are. So number one, we have issuing shares for cash. A lot of times that is the very first transaction that a business engages in. So in this case here, shareholders give the company $10,000 in return for common stock, shares of common stock. So cash goes up, common stock goes up. So both sides increase. Next, we borrow money from a bank, in this case $20,000. Cash goes up, money comes into the business, and notes payable increases. Again, both sides of the equation are increasing by the same amount. Next, we bill customers for services on account. The word on account meaning we're going to be paid later. So accounts receivable goes up by $15,000 and retained earnings goes up by $15,000. Revenue is going to pull up retained earnings, expenses are going to pull it down. And then lastly, we purchase supplies on account. So we now, after this transaction, we have some assets we didn't have before. We have supplies in the supply closet, and we owe our supplier, or the vendor that provided us those supplies, we owe them money. So accounts payable goes up. Notice in all of these transactions, both sides increase, which keeps it balanced. Next, we have asset use transactions. So the first one here is paying down part of that loan that we borrowed in the last slide. So cash goes down by $10,000, notes payable goes down by $10,000. Next transaction, we recognize that some of the supplies were consumed. So we used up some of that stuff we bought in an effort to earn revenue. So supplies goes down, we have less assets than we used to, and we recognize the expense associated with that by pulling down retained earnings. So remember, expenses reduced retained earnings. Next transaction, we pay for an expense directly. So in this case, cash goes down $5,000 and retained earnings goes down $5,000. That could be we paid rent or we paid a utility bill or whatever the case is, but we paid for an expense directly with cash. Next, we paid for a previously accrued payroll. So cash goes down by $4,000 and salaries payable goes down by $4,000. So we're paying a liability from a prior period. And then lastly, we buy back some stock. So cash goes down and common stock is reduced. We'll talk about that later in the class. We'll use an account called treasury stock, but for simplicity purposes here, I'm showing it under common stock. The key thing here on these asset use transactions, both sides are decreasing. That's the basic pattern for this type of transaction. Next, we have asset exchange transactions. That's where we're, like the name implies, exchanging one asset for another. So in the first one, we received a payment from customers for a prior invoice. So we're going to reduce accounts receivable. After this transaction, fewer people owe us money, and we're going to increase cash. After this transaction, we have more cash in the bank. The next transaction is we purchase supplies for cash. So we're trading cash for another asset, some supplies. So after that transaction, supplies increase and cash decreases. So again, in this situation, the changes offset each other on the asset side of the equation. So each one of these has zero impact on the balance between the two. In the same way, now we look at the other side of the equal sign. Here's where we're exchanging one type of claim for a different type of claim, and they offset each other. In the first one, we incur an expense on account. So we receive the cell phone bill. We haven't paid it yet, so we recognize that we have a liability for $1,000 in this case. We increase accounts payable, say we owe money. And we decrease retained earnings. Expenses pull down retained earnings. Next, we accrue payroll. We say our employees have worked for us, they've earned money. That's an expense for the business, so we need to record that we have that liability. Salaries payable increases, retained earnings decreases because we recognize that expense. Last, and this is kind of an unusual one, but we reduce a note in exchange for stock. So we owe somebody money and they take some shares of the company in return for reducing or paying off that debt. So the rules of debits and credits. We record transactions by recording debits and credits in a journal. That's how we record transactions as they occur. And there are different ways to remember the rules for what increases with a debit and what increases with a credit. And this, I think, is the simplest way to look at it. So on the left side of that red line, so on the asset side, we have a T account shown here. So the T account is we're going to have a T account for each particular element within our accounting system, each account. And the debit side is the left side and the credit side is the right side of that T account in every case. For assets, they are going to increase on the debit side and decrease on the credit side. We say that the debit side is the normal balance for these accounts. we would expect cash to have a debit balance, accounts receivable to have a debit balance, supplies to have a debit balance. It's not to say that they couldn't have a credit balance, but a credit balance would be unusual or might be a sign of a mistake or something like that. On the other side of that equal sign, or the red line here, liabilities and stockholders' equity are shown the opposite way. So an increase in these types of accounts is recorded with a credit, and it decreases with a debit. So the normal balance of these accounts would be on the credit side. So a little bit about journalizing. So transactions are recorded in a journal. That's called journalizing. Each separate transaction is a journal entry, represented by a journal entry. So the way to do that is to read the description of the transaction. Usually it's some kind of short narrative that describes a sentence or two about what the transaction was. And then ask yourself, what elements are being affected by this transaction? Are they assets? Are they liabilities? Are they stockholders' equity? And then determine, are those elements increasing or decreasing? And then apply the rules of debits and credits to record the journal entry. Again, keeping in mind that the dollar value of the total debits has to equal the dollar value of the total credits for each transaction. That's how we basically kind of code transactions into our accounting system so that we can use that information to produce financial statements. So as an example here, that first transaction where we received cash for common stock, I would increase cash. You see the number 1 there on the debit side of the cash T account. So I debit cash for $10,000 and I credit common stock for $10,000. The second transaction where I borrow money from a bank, I increase cash with a debit of $20,000 and I increase my note payable, my liability, with a credit of $20,000. The format for journal entries is always debits first. So we always show our debits first, and the account name is left justified. They have some parenthetical indications of asset or stockholders' equity increasing or decreasing. You don't really need to worry about that. But you'll put the name of the account for debits completely left justified and enter the dollar amount under the debit column. And then credits you would indent about 4 spaces and record in the credit column. That's how we record journal entries. It's a good idea to leave a blank row between one journal entry and the next, just so that they don't run together, so that it's clear that these are separate transactions that you're recording. And again, debits have to equal credits. So please hit pause and work through the in-class practice for Chapter 2-1, which is taking the transactions that we had in those different grids and recording them in journal entry form and then posting those to T accounts. And then look at the solution. So posting to the general ledger, in this case here, after we've recorded all the transactions, we'll post each line to the particular category on the general ledger for that particular account. Some companies will do this with T accounts, or for illustration purposes, you can use T accounts. In other cases, we use a formal ledger type document, which is what I have in the solution for for the in-class practice number 2. So go ahead and hit pause and record that on in-class practice 2-2, record the transactions that we did for 2-1, then into the general ledger format. You can, if you need to, you can look at the solution if you get stuck. Finally, we will look at the ending balances. Once we've posted all of the accounts to the general ledger, we'll look at the ending balance for each general ledger account, and we'll record that in a trial balance. So a trial balance is simply a listing of all accounts in financial statement order with either the debit or the credit balance shown. And you can see here the primary purpose of this is to make sure that debits equal credits, that there aren't some mistakes before we move forward. One of the mistakes that we would look for here is maybe accounts that have a balance that's different than what their normal balance would be. For example, if I had a credit balance in supplies, I would know that a mistake was made because I can't physically have negative supplies. So I would then correct that mistake and then redo the trial balance before I move forward. So that is the end of the lecture. You can now do the in-class practice for Chapter 2-2 as well as the 2 homework assignments for Chapter 2. If you have any questions, please reach out. Thank you.